What's up, guys? I'm Arnold Olshansky. I got my partner here, Tyler Evans. Today, we really want to take a lot of that information and really break down what some of the opinions, some of the forecasts, and just how people are seeing the market today and how you as a passive investor could be more prepared for the opportunities at hand. So a couple of things that we're going to talk about today. Number one, the current state of the market, the opportunities, the risks out there, really what you need to know and how to protect your capital. Whether it's a buyer's or a seller's market, a lot of people are always wondering, is it the right time? Is it not the right time? And we'll let you know what people are saying as well as kind of what we're seeing in the market. We're also going to talk about whether you should invest in Class A properties, Class B, Class C, and some of the differences in those investment classes. So we're going to touch on that. We're going to speak about bonus depreciation coming back. And lastly, we're going to give you a list of questions to prepare you for what you as a passive investor should be asking your sponsors in today's market, how you should be looking at deals in order to not only protect your capital, but also to grow your wealth. So I'll let Tyler T go ahead and introduce yourself for people that may not know you. And then I'll go ahead.
All right. Sounds good. So Tyler Evans here. I've been in multifamily for about 17 years. I started leasing apartments when I got into the industry and held every role there was in multifamily until I was overseeing a portfolio of around 6,000 doors. So partnered with Arnold a little over 4 years ago with Aligned and been going strong ever since.
My name's Arnold. I've been a serial entrepreneur since I was 20 years old. I built 4 companies, exited a couple. And when I entered in commercial real estate, I think one of our biggest philosophies and principle was don't raise a single dollar. Go put your money where your mouth is, prove your ability to execute. And obviously now we're growing the company where we're always investing at least 20 to 30% of our own capital in every deal. But obviously we're growing it now with other like-minded investors. So that's a little bit about us, a little bit about the company. So yeah, let's, I guess, dive into our first topic, T. What do you want to chat about?
No, absolutely. So Arnold, let's talk about what is the current state of the market and how did we get here?
Yeah. So we're definitely going to chat a little bit about the current state, but I think it's critical for people to understand what has transpired in order to get us here. So in about 2020, right, the federal government, COVID happened. They wanted to stimulate the economy. They dropped the cost of financing to almost zero. I think it was like 25 basis points above the Fed rate. So the cost of money was so cheap. Now, whenever the cost of money gets really cheap, commercial real estate values start increasing because it doesn't take a lot to, the debt payment is going to be less. So there were a lot of operators at that time that started getting these bridge mortgages. These are these kind of adjustable programs where they're locking in these rates for 2 years, maybe 3 years, and then they have to refinance or sell the property. What happened was the greatest rate hike in history. In the next 2 years, rates went up from almost zero to about 4%. I think it's about 4.4 today, last time I checked. But now what happened is all these operators that took these adjustable mortgages and they were taking crazy leverage. I mean, they were leveraging these properties on 85%, 90% LTVs. Now they can't refinance these properties, right? So the fundamentals of multifamily are still super strong. We have a massive shortage of housing, but interest rates changed. And now a lot of folks that got these properties 2-3 years ago thinking rates would never go up, kind of gambling a little bit, they're in trouble, right? Their properties are in trouble. They can't refinance. They can't sell. And the banks are trying to work with people, right? Because the banks are not in the business. They don't want to take back the property. So they're kind of kicking the can down the road right now. But there's only so long they can do that until they either start taking back properties, foreclosing properties. And right now is just such a prime opportunity for people that are well capitalized to take advantage of some of these bad decisions that people made a couple of years ago. So there's a lot of opportunity, a lot of discounts. And it's about really just finding those right deals. T, what are you seeing?
Yeah. So just to add on to what you're saying, right? I think absolutely the huge rate hike really just threw everybody off. They thought money was going to be free forever. Obviously it wasn't. And they were in the adjustable rates. So, I mean, that's the big cause for it. And I think, again, it's different than 2008 housing crisis because bad loans were really the cause and real estate as a whole was really shaky, right?
Yeah.
So contrary to that, right now, multifamily in particular, phenomenal fundamentals, especially here in Texas where we're seeing, jobs coming in from all over the country, people are following. So the fundamentals of the market are so strong. Yeah. Right. But it's just these guys who got in these bad deals and, that's really what caused this. But as a result, we're just seeing great discounts.
One of the basic rules of investing, whether it's stocks, real estate, doesn't matter, is don't over leverage yourself.
Yeah.
If you over leverage yourself and markets turn, tides turn, I think Warren Buffett has a quote, when the tide goes down, you see who was swimming naked.
I love that.
Well, right now we're seeing who was swimming naked. So it's always, you have to have a buffer. You have to be conservative. I pride ourselves for having that discipline because when we entered that space, we had like 3 caps, these crazy bidding wars that were unjustified. We remained disciplined, and the properties that we acquired during that time frame, we were able to make super profitable, but we also locked in long-term debt. So we don't have kind of these pressures. We have to refinance. We have to sell. And that I want to kind of take into our next topic, which is it a buyer's market or is it a seller's market?
Yeah.
What do you think about that?
Well, I think it is. It's hard to tell sometimes, right? Because it's very even sub-market specific and deal specific, right?
Right.
Because, we have a lot of deals right now. Everybody's wanting, 90s, 2000s builds. And if it's well located, then you are seeing, deals going with 15 bids, a lot of competition for those. But then you'll have off-market, maybe C-class deals, and there's, they 1 or 2 guys get a chance at it. So, depending on the situation, it could go either way. So you need to know kind of what's going on each deal.
Yeah, for sure. I mean, I think it's definitely a buyer's market right now because nobody is selling property right now unless they have to sell. Unless they have some type of reason to sell. Everybody knows that valuations have dropped. I mean, we're talking about, you're talking about 20, 30, 40, $50 million properties, that went down by 20, 25, some even 30% in value, not because of any fundamental changes. Like we still have such a huge shorting of housing. All the fundamentals are still there. It's just rates went up. So, the people that are really entrenched in the business that kind of know eventually, hey, rates will go down, whether it's in a year, whether it's in 2 years, that you can't predict. Don't try to market time that. But if you lock in long-term financing for 5-7 years, you're putting yourself in a position that when rates do go down, those values are going to skyrocket again. But right now, what I'm seeing is, a 20% discount off 30, 40, and $50 million assets and plus, right? I mean, it doesn't feel like that a little bit because, there's still a lot of competition because the smart money knows right now is the time to buy. So, when we're bidding on a deal, there's another 10 people bidding on that deal. So there's still a lot of competition for these deals. So a lot of people were kind of waiting for, is there going to be this major distress? And there is going to be distress, but there's just a lot of smart capital and a lot of smart investors that have been sitting on the sidelines waiting for this opportunity. So it's not like you're going to be the only one in this buying pool. You still need to compete. You still need to win. But you're getting a massive discount compared to just 2 years ago. Yeah. And I mean, you're still the fundamentals are all there.
No, I like what you said. I mean, you're 100% right that nobody's selling an asset right now unless they have to, and there's multiple reasons. We have record loan maturities coming due. Obviously, the people that are in the adjustable rate deals and their deals are not cash flowing. They're literally on life support. And those are the deals that we're seeing come to the market. And we have nowhere near the competition we had in 21, 22, right, where we were seeing 30 bids on a deal, and it was 3 best and final. So we're not there, which is great. And I think a lot of people are still sitting on the sidelines, but, we're seeing huge opportunities right now.
Yeah.
And I think, you sit too long, you miss the really good ones, and the market's already rebounded. And as soon as you get too much capital coming back in, the prices will go up. So definitely a great buying opportunity. But yeah, I guess I would say it's more so buyer's market right now.
Yeah, I think one thing that I will add to that, also in the past 2-3 years, construction has really slowed down. So that's going to have a huge impact in the years to come. Because, for example, we focus on the Texas market. We love this market, just the demographics, the employment growth, the amount of people that are moving here. But, Texas got built up, right? There was a lot of inventory coming out. In the next 2 years, that inventory is going to get absorbed with the amount of people that are moving here. However, also construction has stopped. A lot of these new developments, developers, they're not able to get deals to pencil. When interest rates are really high, it's very hard for them to start building, especially when inflation is high and the cost of material is higher. So project starts have been far and few between. Now, what does that lead to? 2-3 years down the line, when absorption does happen, right? All of these properties, do get absorbed by renters. Now there's going to be very little supply hitting the market. And when there's little supply, the existing inventory, it's kind of a trickle effect. You're able to increase rents. And when you increase rents, your property values go up. And that a lot of people are forecasting is going to be such a huge driver to property appreciation in the next 3 to 4 years. So a lot of upside to come just with those dynamics as well.
Yeah. I mean, again, market fundamentals are so strong right now. But you're right. Yes, the construction starts have dropped off dramatically. They just don't make sense with all the materials, everything you said. But we're being very conservative in our underwriting. Yeah. We're even in, during that time of great demand, we're still being conservative with 2.5% rent growth. But in reality, if it does play out that way, you're talking huge upside there.
Yeah, for sure. I'll say this also. Another thing that I'm noticing in the market today is a lot of these sponsors and operators that were acquiring deals 2 years ago, I feel like they learned their lesson of being overly aggressive on their assumptions. Because they saw what happened, right? When you take all this leverage, when you kind of have this fear of missing out on deals, this kind of FOMO mentality.
Oh, yeah.
And now we see people underwriting much more conservative. Now, why is that important? Because guys like us, we're not going to be able to compete with people that aren't thinking about the numbers, right? If there are people out there that are just, hey, I just want to win a deal because I'm going to go make some acquisition fees, asset management fees. That's not our boat, right? Before being a real estate syndication company, we're investors first and foremost. We have so much of our own capital in this game. Like if the numbers don't make sense, we're not going to acquire the property. So 2-3 years ago, when we were seeing these really undisciplined underwriting practices, we said, hey, we're going to be super selective. We're going to build our internal property management. We're going to work on kind of building the foundation for when this time comes around, we have the dry capital to go and execute. But now we see that a lot of people learn from some of these mistakes. They're not putting in crazy rent growth projections. They're not being overly optimistic on their underwriting. And why that's important is because now conservative operators could come in and compete without kind of just this guy that is really not understanding of the numbers, throwing around offers.
Yeah, which 22 when we were in that boat, right? And we're putting in offers and just getting beat several $1 million more than what we knew was a real number.
Yeah.
And, and we're like, man, what are these guys seeing that we're not seeing? But we stuck to our guns. We're like, we're not going to make reckless bids, and now these are the deals that we're seeing come back around because they're over levered and, so it's just a good lesson, right? Because you do feel that where you're like, everybody's buying buying deals. We want to buy deals too.
Yeah.
But, we have our philosophy and our thesis, and he's like, okay, we got to do us, stick to the way
sure.
we do it. And, thankfully we did. So
Yeah.
now we're poised to come in at this great buying opportunity time and take down some deals.
Yeah, for sure.
So moving on, you think it's the right time to invest in the market? And if so, tell us why.
I have a very biased opinion, right? But I have 80% of my net worth allocated to this asset class. That's how much I believe in it. But there's reasons for that, right? I'm seeing what's happening in terms of, we focus on Texas, right? The amount of people that are moving to Texas from California, the companies that are coming here, the demand drivers, just basic supply and demand fundamentals, right? Real estate evaluations are only supposed to keep going up. The only reason that we had the setback, in my opinion, I don't want to say the only reason, right? There's so many different headwinds, but a huge reason is really these interest rates, right? To control inflation. But if we think about what happened, 3 years ago or 2 years ago, nobody believed that the Fed was going to have a soft landing. Like, if you remember this, everybody was talking about, hey, we're going into a recession, because we had inflation up like 8-9%.
Yeah, it was
right?
a lot.
And the Fed's number, they have a dual mandate, right? Number one is price stability. I feel that's their number one priority. If inflation is rampant, right, they got to get it under control.
Right.
Number two is stable employment, right? As an economy, we're doing amazing unemployment. I think we're at 96% employment rate. I don't have the exact precise data as of today, but last time I checked.
Doing well.
So if we take a look at what happened, we were at 8-9% inflation. Now the Fed obviously increased rates, because when inflation is going up, they really only have one tool they can use, right? That's increase interest rates, slow down the demand, right? And that kind of curbs inflation. So, they did that. They got a AAA plus rating in my book. They got inflation from 9%. The last readings were around 2.5%. So they succeeded.
Right.
So right now, the way a lot of people are looking at the market is the number one barometer, so to say, that the Fed is looking at is where is inflation, right? And how is employment doing? And if inflation is doing good, they want to continue stimulating the economy, and they're going to further lower interest rates. So based on where we are today, we are forecasted to have more rate cuts. Right now, that has been put a little bit on hold because of everything that's going on with our trade policies, right? There's a little bit of concern of how that's going to impact inflation, and we'll get into that a little bit as well.
Right.
But overall, if interest rates were the main driver to get property values down, and the main driver for increasing interest rates is inflation, let's look at that core data. How is inflation trending right now? And if you look at the past 2 years, Jerome Powell, head of the chair, was able to get that down from, somewhere in the 9s on the CPI to last I checked was trending about 2.5%. So
like 2.3.
A lot of people feel like, hey, when rates do go back down, that 20-30% discount that we're seeing now, that's going to be non-existent.
Yeah.
Right. So right now we are 100% like acquisitions mode.
Yes.
Find those deals. But always maintain the discipline to keep saying no until you find the right one.
You got to say no.
You got to say no.
What's the quote you love? You got to, for everything you say yes to, you got to say no to something else.
Oh,
right?
absolutely,
So
absolutely.
Like all these deals that are just okay, you're like, no, it's not. It doesn't meet our strict criteria. So, we got to say yes to the right one.
Yeah, so. That's probably, staying disciplined even during opportunities is critical. Yeah. Right. On average, I would say from the stats that I've been looking at on the company, we're looking at 40 deals. Just to submit one offer, not even get a deal. Right. Just to submit an offer. And probably the full averages on that, to win a deal There's probably about 100 to 150 opportunities we need to look at to go into contract.
Yeah.
Right. And I mean, I'm a big believer in that as an investor, and some of the greatest investors, follow these principles is, one of the biggest skills you could have is the ability to say no. Right. So if you're working with a sponsor, that's a question you could always ask is, how many opportunities did you look at before this? Because it's a sponsor's job to say no for you. It's a sponsor's job to screen out the bad deals. So yeah.
Yeah. I think another good point is institutional capital, right? They're not in as heavy as they were. They're starting to come back in, right? Because of all these great reasons you brought up where, the market's improving and stabilizing. So we're seeing them start to come back in, but it's nowhere near it was.
Yep.
So, once they come in full blast, they have these huge funds. They're going to open the floodgates of capital, and that's going to bid up the deals. Again, it's going to increase the value dramatically. So,
Yeah, and I'll comment also like on institutional capital. These are kind of these big private equity firms, big banks. Remember, their number one objective is not building wealth. Their number one objective is wealth preservation. So they are the most conservative of the conservative.
Oh, yeah.
Right? So usually with times of even slight uncertainty, they put their pencils down, they kind of sit on the sidelines, which is good in a way because when all the institutional money comes back and you start having all the competition from them and they're bidding up the prices on these deals, it's harder to secure those really good deals. So we're already seeing institutional capital start jumping back in. Now, they haven't hit that full wave.
No, not at all.
Right? So, but when they do hit that full wave, that's going to just keep increasing real estate evaluation. So
it's a good sign that they're feeling comfortable enough in the stabilization of the market to kind of creep in. But we want to take opportunities before they get fully involved.
You definitely want to be. You want to be like. It's good to be a little earlier than the full flood of institutional capital.
So that kind of takes me into the next question, right? Because we talk about institutional and what they actually invest in. So let's talk about the difference between investing in A, B, or C class deals. Tell me your thoughts on that.
Class A is kind of your newer properties. Things built in 2010 and up. They have amenities. They have pools. These are your higher rents.
Shiny new.
Yeah, shiny new.
Yeah.
So they attract a different demographic. Class B is a little older properties, maybe 90s build, 2000 build.
Yeah, still nice.
It's still nice.
Not as new.
Right, different kind of rent demographic, different type of tenant. Usually people making around maybe 80,000 a year.
Right in that ballpark.
Right, the Class A attracts more of the folks, making six figures and up.
Yeah.
And then you have Class C. These are kind of your older builds. And Class C is, again, probably could be built in the 70s, 80s. Could have boilers and chillers.
There's a pool, not really any other amenities.
Exactly. So and that attracts a different tenant base, right? So those are people that are making more or along the lines of anywhere from 30, 40, maybe $50,000 a year.
Industry.
Right, service industry, folks like that. So class, that's kind of the high level difference between A, B, and C. So there's been a lot of opinions on what's the right asset class today. So, T, maybe you could share some of your takeaways from the conference.
Yeah, so definitely a big topic, right, that everybody's talking about, the flight to quality and why everybody's looking for the B plus, maybe the A deals. And I think, the thing that we hear the most, which makes a lot of sense, is that for not that much more, the spread between the asset classes used to be, actually around 1% cap rate.
Yeah.
Right. So, you can get a C class for 7, B for 6, A for 5, and like you were saying, the cap rate is kind of the multiplier on the money.
Yeah.
So obviously if it's a higher cap rate, you're making a little bit less on the deal. If it's a lower cap rate, the more you make. right? So it used to be a big spread, but right now it's not.
Right.
You know, it's 25, sometimes 50 basis points between the two. And when you're talking about, you know, even a C property versus a B property,
Right.
it's a big difference in the product of that, the quality of the product. So, you know, you mentioned boilers, also chillers or something we see in C properties a lot. So as an operator, if your boiler goes out, well, first and foremost, all of your residents are without hot water, which is awful, right? You never want to inconvenience your people. But then secondly, you have a huge expense that you probably didn't forecast, right? So now if you didn't put in that buffer, you have to come out of your cash flows, means your investors don't get paid, right? But so if you go to a B-class property, individual hot water tanks, that's almost standard. Every now and then you might have one with the boiler, but it's rare. And then A-class, you know, also hot water tanks, but new ones, right? So the further up the scale you go, the less risk you have as an owner, operator, you know, as a sponsor, because there's less likelihood of any of these unexpected maintenance things happening.
Right.
You know, chillers, same thing.
Right.
One big central unit cools everybody's apartment.
Just to give people a little bit of context, you know, how important a cap rate evaluation is. So as Tyler was saying, you know, between asset classes, between maybe a B and an A, you know, the spread being 100 basis points, so 1%. Just to give everybody kind of an illustration of what that means. So the way commercial real estate is valued is you take your net operating income, right? It's kind of the profit that the property generates, not including the investments you make into CapEx and some other costs. And then it acts as a multiplier. So if something, for example, is a 4 cap, okay, you could look at that as a multiplier of revenue. That's about like a 25x multiplier. So if that property is making $1 million in revenue, a 4 cap means that property is worth $25 million. Right now, if you have a different property that is a 5 cap and it's also making $1 million in revenue, okay, the multiplier there would take that property, it's going to be worth around $20 million. Right. So that 1% difference on $1 million in revenue, you know, is going to be a difference of $5 million of what that property is worth. So before, you know, if you bought a Class C and it was a 5 cap and a Class A was a 4 cap, right, you could kind of justify that difference, right? Okay, well, you know, that $1 million in revenue, I'm getting this property for $5 million less. So maybe it's an older property, right? Maybe it's going to have certain issues that come up, but because I'm getting such a discount on it,
it's worth it,
right? Compared to the newer product, I can build some contingencies, right, for the boiler breaking, the roof needing repair, and still come out on top. Right now, what has happened recently is that spread is maybe 25 basis points, right?
Yes,
30 basis points.
Dramatically.
So now, let's say you have that $1 million in revenue, you know, and now a Class C, you know, is worth, you know, 20 million, and that Class A is worth, let's say, 22 million. For a lot of folks, they're saying, well, why am I going to take this older, riskier asset for a $2 million difference? You know, so that's what's happening right now between A, B, and C. But there are some caveats to that.
Right.
So I'll let you go. And, you know, what do you think, you know, based on this spread, should people be looking at B, C class properties when there's not that big of a difference with A's?
Yeah, no, absolutely. I think it's risk-adjusted returns.
Right.
That's what it's all about, right? So if, you know, there are C deals that are priced really well and they're well-maintained assets, and yeah, there's a bit of a risk, but sometimes there's a mitigation for that risk. Maybe, yeah, it has a boiler, but it was just replaced,
right,
and it's got a warranty for 5 years, right?
Sure.
Like, okay, and they're giving a great price discount on that.
Right.
So in that instance, you know, it does make sense because you could kind of mitigate that. There's a buffer built in. And then there's, again, A-class deals right now that are at such a discount. to the replacement cost and to the high that
Right.
they were just a couple years ago. And we've already talked about the fundamentals. It's like there might be more competition on that deal a little bit,
Right.
but if things go the way that we project they will go, it's just a phenomenal opportunity.
Yeah.
So I think there's an opportunity in each and every class.
Right.
But like you said, I mean, we're looking at 100 deals to everyone
Right.
we're going to get. So
Right.
you have to go through a lot of not good deals in order to find the good ones.
Sure.
But as a sponsor, and we like value add, we like upside. So
Yeah.
I think we look personally at all the opportunities
Yeah.
until we find the right ones, because we want to find our investors the best opportunities out there.
Yeah, and like my thoughts on it is we're definitely going to continue looking at Class C, B, and A. And the reason for that is, if you just say I'm going to look at Class A only, you slow down the amount of opportunities you could look at. And sometimes there's these Class C and B deals that are just these diamonds in the rough that have so much upside. Because also when we say this 25 basis points, we're talking about this big macro thing. Sometimes depending on the submarket, right, there could be a 50 basis point spread. Like you said, sometimes there's a Class B or C, they just got brand new roofs. They don't have a boiler chiller system.
Yep.
A lot of these unexpected CapEx surprises that you may happen, they're not on every single deal, right? So it's about looking at all these deals, because if you just limit yourself to Class A, now you're looking at, 10, 15 deals a week. But if you open up B and C, now you're looking at 40, 50 opportunities a week. And again, to find the good deals, you got to look at as many opportunities as possible, right? So I believe there's a lot of opportunities still in Class C. You just need to know how to mitigate that risk. So, if you're a passive investor, I'm going to give you a couple of tools that you can ask your sponsor, and T, maybe you could chime in as well on how you could kind of find out how they're underwriting, right? So on Class C, a couple of questions I would say is, does it have a boiler system? Does it have a chiller system? That would be there. Let's start. That's a big one, right? Another question I would ask is, how's the roof condition? When was the last time it was replaced? By the way, if your sponsor doesn't have the answers to these questions, I would kind of, that's a little yellow
Bit of
flag.
a red flag.
Yeah, I'd say yellow. Yeah. Depending on when they're presenting the deal, they should already kind of know most of this information, right? So. But you want to ask about when the roof was replaced. But your follow-up question to that should be, depending if there's a boiler or chiller or a roof that might need repairs, you want to ask them, what kind of buffer did you put into your CapEx budget? Just in case this does break down, just in case something does happen. Because if somebody doesn't put a buffer on any of these expenses and tells you you're going to make 2x on your money, right, and they don't have any cushion for unexpected things to arise on a Class C or a Class B, I can almost guarantee that you're not going to make 2x on your money.
Yeah, no, it's like you said, it's risk-adjusted returns. And we know, it's just a fact, things are going to happen.
Yeah.
An 85 property, like, that's old now.
Yeah.
45-year-old deal. And you're going to have plumbing, you're going to have this and that. So, great question. Always, what kind of buffer do you have? What kind of reserves do you have? How are you going to mitigate when these things do come up?
Yeah.
Yeah, no, you want to hear the answers, not, we're going to take it from your cash flows. Right? So.
Well, yeah, if it's, hey, we're going to call you and make a capital call for you to fund more of the money, I don't think anybody would say that. But if they don't have a buffer for some of these things, you could rest assured that's going to be a call
that's going to happen.
That's a call that's going to happen.
So
what are some other questions? If somebody's being presented a Class C deal to invest in, right? So we talked about boilers, chillers.
Roofs.
What other things can they ask? To get a feel for the condition of the property.
Yeah, I think a big one is plumbing. I've been running properties for a long time, and C, B class deals, that's always going to happen. There's always plumbing issues. But as a sponsor, when you're buying a deal, really the most impactful thing you could do is to have all the lines cameraed. So, hey, did you do this? What did they find? And what's your plan to mitigate it, right? And if there's no issue, great, but you want to hear that they've done the diligence, that they've gone through. So that's a big one.
But also, it's not just these extra costs that come up. Right, if the plumbing breaks at the property, right, if the boilers or the chillers, something happens there, I mean, T, with all your years of experience, you could talk about what happens to the tenant satisfaction and them staying. Like maybe you could share some examples.
Yeah, no, absolutely. So it's your reputation is what suffers, right? So I actually ran a property in Oklahoma, and it had a nightmare of a boiler.
Yeah.
And I swear, every time I came into town, I would come every couple weeks because it needed that much attention. But we'd wake up in the morning, we'd come to the property, and water would be flowing down the main road. And the city would be like, "Oh, you got another leak," because it was either, again, people didn't have enough hot water, so they would turn it up, and then the lines would just break.
Right.
So and to fix that, you have to shut off the water to the property, and it happened so frequently that we begin losing residents because they were tired of it. They're fed up. You get negative reviews. They're like, "Don't live here. They never have hot water.
Right.
It's always off," and it damages. just the overall profitability of that asset, right? So it's same with the chillers, and that's also just another great tool. When you're looking at investing in a deal, Google it and look at the reviews.
Yeah.
Right? That's what I do when we're buying. I get on there. I want to see people's complaints.
Right.
If they're like, there's never AC, they have a chiller, it's always 85. Like, that's a major concern. Say you have 5, 10, 15 of those reviews, you can almost bank that you're going to need to do a major chiller revamp or, do something.
And that's such a good tidbit. Thanks for sharing that, T, right? It's like, as a passive investor, think it takes you literally 5 minutes, right? You got the name of the address. You got the name of the property. You put it into Google, right? There's going to be Google reviews. Just read through some of those reviews. By reading through some of those reviews, you're going to have a really good feel of how that property is being ran. Now, if you see a 2 rating out of 5 with 20, 30 complaints, you probably want to go back to your sponsor and be like, "Hey, what's the game plan here?" Right? Like, I'm not saying that that's necessarily a bad deal. That's not a deal breaker.
Sometimes it's an opportunity.
Right. Sometimes it's an opportunity because if their business plan is to come in and take over property management, so we have property management in-house. So when we see those things, to us, that signals opportunity. That means they're not running the property well. We could come in with our team, run the property.
Focus on customer service.
Exactly.
Get the ratings up.
Get the ratings up. And why is that so important? Because when you got people renewing and not leaving, that drives the cost down to run the property, which increases your NOI. And again, your NOI increases, the property value increases, right? But if you see as an investor, if you're going to see a bunch of negative reviews and you're going to call your sponsor and be like, "Hey, what's the plan? With improving the management?" They're like, "Oh, we're going to keep the management that's in place." Yeah, that would probably be a little bit of a, I don't know if it's a red flag, but definitely a yellow flag.
Yeah, for sure. What are you changing?
Right. And switching to another third property management company is not that easy either, right? Because if one company isn't doing that well, just switching to another one, you don't know how they're going to do unless you have extensive history with them. Right. So if they are switching to another third party provider, as a passive investor, you want to say, have you done business with them before? Right? If they haven't done business with them before, if they just were recommended or something like that, that doesn't mean much. The reason we bought property management in-house is we were also recommended these third parties. And
pretty big name in the market, thousands of units, and
that doesn't really mean much unless you've worked with them, unless you know how they run operations. Just switching another third party doesn't mean it's going to be successful. That's why, we kind of built our own third party. So we like to use other companies, but if they're not able to perform on the business plan, we know in a week's time, we could step in and take over operations, and get that property to where it needs to be. Because if you mess up 1 time, 2 times on who's running the property, 2 times is enough to be completely off your projections in terms of profitability.
No, it takes a toll on the property itself. Your residents, a lot of what commercial multifamily is resident satisfaction. You boil it down. Obviously, we have the whole buy side. You got to buy it right, or it's not going to work out. But operationally, if you keep those residents happy and they're fans of you and your business, then you're going to succeed. But when you're switching the manager and the management company, that usually comes with, software changes, how they pay their rent, who they're talking to, and, it just disrupts the whole flow for the residents. So, if you put somebody in there and they fail, and there's also a lot of other errors that comes along when they're failing, right?
Yeah.
They're not communicating well with the residents, whatever. And then you change it. If you fail again, it's really hard to come back from that.
Yeah.
So, it is important that they have a relationship, or, they've really vetted this third party that they're putting in place here.
For sure. And to also talk about kind of, the topic of should you invest in Class A, B, or C, the other comment that I'll say is, at the conference, everybody's talking about this flight to quality, right? Everybody wants these Class A product. Everybody wants to look at that. Well, what happens when everybody starts running in that direction? They start bidding up the prices, right? And there's a lot of groupthink that happens, a lot of conformity. Right? Everybody say, "Oh, we're running there. Okay, let's go." Right? And they just keep bidding up the prices, and Class C and B get left behind.
Yeah.
So there's less competition, and when you start seeing less competition, you could scoop up these deals at an amazing basis that don't have a lot of these inherent risks that we're talking about, and really make a Class C or B really worth it.
You could, yeah.
Now, I think Class A is also a great opportunity right now because the prices on some of these Class A's, again, also drop by 15, 20%, where, if you talk about replacement cost value, and essentially what that means is how much would it cost to build this over again? You're buying it less than what it would cost to build it again.
Yeah. We're seeing that across the board.
So when you have opportunities below replacement cost value, if there's ever kind of a time where real estate makes sense, that's going to be huge. And especially with, less inventory coming on the market right now. Sure, we have a little extra supply right now in Texas, but that's getting absorbed so rapidly. Like I said before, with all these construction stops, right? If you're buying some good Class A right now at the right basis, but you need to know how to underwrite it. Okay, you need to know.
That's a good point.
You need to know how to look at Class A also to make it make sense, right? So let's flip that switch a little bit, right? Let's talk about kind of Class A, right? So passive investor, right? They get a Class A deal being presented to them, right? We spoke about some of the questions they should be asking on these Class C assets. What are some of the questions they should be asking on Class A?
Right. So Class A deal, right? Everybody gets the same T12 and the same rent roll. And that's really what you're basing your whole deal on. So the question for most Class A is, what are you going to do to add value to this deal, right? How are you looking at it? What opportunities do you see that everybody else doesn't, right? So it's about adding the ancillary income opportunities there that, and you kind of want some market proof there. I would say I do anyways. Right, because there's so many things. Everybody does, smart home packages, valet trash. There's a lot of these things, but real estate's such a local game, sub-market, and if you have, say 3, 4, 5 other Class A properties that you're competing with, it's like, does the market accept that upcharge? So that's kind of what I would try to find from the sponsor. It's like, okay, so you're adding, say 4 new charges,
right?
Do the comps have these charges? It's like, well, none of them do. Is there demand for that? Because, they could think there might be, and they go out there, there's no market proof.
Right.
And then lo and behold, they pick the other properties because they don't charge that. They don't want that. But on the contrary, most times we'll find that there's demand for certain things, or there could be just something that is lacking is a great opportunity. So, that's kind of what I would want to learn from my sponsors. Is there demand, or if not, is there something lacking that you think the market would accept, and why? And then it's also median income, right? Maybe talk a little bit about that.
Yeah, for sure. So median income and RTI stands for rent to income ratio, is a critical metric that you should be asking your sponsor on a deal. So the specific question you want to ask is, what is the rent to income ratio in this submarket? And I'll give you a couple of rules of thumb, right? If it's below 30%, good, right?
Yeah.
Below 25,
Great.
really good, right? If it's like 30 to 35, and if it's above 40, it's like, hold on a second, right? So why is that such an important number? Like, let's talk about what does 30% mean, right? Rent to income means this is the median income of the neighborhood. And 30% would mean from their median income, they're giving away 30% of their money that they make to their housing.
Right.
Right. So when you have somebody, let's say, giving away 40% of their income towards housing, there's very little room to grow rents. And the big, one of the huge drivers to increase the property value, because that's what you're doing in commercial real estate, right? It's different than residential. You're coming in, you're increasing the amount of income the property generates to increase its property value, right? If you already have people giving away 40% of their income to rent, it's very hard to keep adding to that, right?
Oh, yeah,
like
for
people
sure.
are just not going to renew. People are not going to come in, so you always want to look at what is the rent to income ratio, especially if you're looking at Class C and Class B properties. Usually Class A has a good rent to income ratio. You still want to check that. But Class C and Class B, these are folks, again, Class C making about 40 grand a year, 50, right? Class B maybe in the 70s, right? For them, they're on a tight budget. Right? They have their grocery bills, all these bills. So if you have, like, I don't even want to look at anything above a 30% rent to income ratio right now.
Yeah.
So definitely you want to look at that. And then with Class A, T, to your point, right, just to educate the viewers a little bit more, right? In Class C, there's a lot of opportunity to find properties that are below market. So let's say you have 5 properties in a vicinity, right? And 4 of the properties are renovated and they're charging $200-$300 more per unit. What does that show you? That shows you that there is demand for a more polished, upgraded product, right? So when we see that and we see we're $200-$300 below the rental values, and we say, hey, we can invest $5,000-$7,000 into each unit to bring it up to market and then increase the rents by $200-$300, that's a huge return on capital, right?
Absolutely, yeah. When you do the cap rate multiplier, you can see that.
Right. So that's kind of the Class C, one of the big components of that business plan. Class A is a little bit different because Class A, usually the rents are already at market value.
Right.
You're rarely ever going to find like 5 Class A properties near each other and one guy just charging $300 less, right? So that's not the angle you approach those business plans on. The angle over there is more along the lines of, in terms of revenue driving, what can we add to this property and charge more money for it? It falls under your other income line item. So can we include a Wi-Fi package? Can we include a dog walking service, right? This clientele also wants a different thing than Class C, right? Class C doesn't want their chillers to break, right? Class A wants some type of amenities, some types of perks.
A little bit more catering,
Right. And this is what you want to ask is, how, to your sponsor, how are you planning to increase revenue on this Class A property? What are you planning on doing? And if they say, for example, we're going to charge an extra $100 for a Wi-Fi package, and we're going to charge another $100 for a smart home package, and we're going to do a dog walking service. The first question you want to ask is, are any of the comps doing that?
Right.
Right? They should have the answer because that's part of your comp study.
Got to do the research.
Yeah, you got to know, like, those other buildings in the vicinity, do they offer other amenities? Now, if they say, no, they don't offer that in particular, right, then you want to follow up to that and you want to say, well, what makes you feel that people are going to want this?
Exactly.
Right?
Yeah.
And then usually, look, when you're underwriting Class A stuff, right, there's going to be some assumptions. You can't just forecast, you have all these ideas of what's going to happen on what you could add on. And let's say you feel it could add on another $500,000 in revenue. right? Conservative underwriting would say, take that $500,000 and slash it to $250,000.
Yeah.
Right. And if you get to $500,000, great. You're going to deliver more profits to yourself and to investors.
Exactly.
Right. But you can't assume that you're going to take over the property. Everybody's going to take the dog walking fee, the smart home package, the Wi-Fi. Like you can't bet on that.
Yeah.
Right. You got to know what the competitors are doing. Then you got to make sure that the current property you're buying isn't already doing that. Otherwise, you can't add value.
Of course.
Right?
Yeah.
So if it's not doing that and the competitors are, then you calculate how much extra income you could get and then cut it a little bit. Cut it a little bit,
Right.
create a buffer, create a cushion. And that's what you want to ask your sponsor is, how much other income do you feel you could get and what type of cushion are you putting on that, right, in case you don't get that? A good answer would be, yeah, all these comps have, this and this service, and they're charging this amount of money. If we do that, we'll get this amount of revenue, and we discounted it by 20%.
Yeah. I think, another important thing to look at, something we do in our underwrite is, there's a total rent amount that these people are paying, right? So what we do is we take your rent, any utilities, any add-ons.
Yeah.
And then we have what's the grand total that we're expecting the resident to pay every month. And we do that for our property and we do it for all the comps. And you have to look at that total number and you say, is our product worth as much or hopefully more than these competitors, right? And if you're adding all these things and at the end of the day you look at the competitors and say, no, theirs is still better.
Yeah.
Right? Then, you might have a hard time achieving that. So you have to take that holistic view into account as well.
Right.
If you get too micro and you're like, yeah, dogs, cable, smart home, okay, great. They're all gonna work, right? And I think slashing it in half does help with your acceptance rate on that. But it is important to look at big picture for your sponsors, for you guys as passive investors to be sure that they're not overshooting the mark.
Yeah.
So
and look, the other way that people can increase value in a property, whether it's a C, B, or an A, right? There's really two levers you could pull on, right? Number one is you're going to increase revenue, which we just spoke about.
Yep.
Like, can you do renovations, increase prices? Can you add other charges for more services? So that's the increasing revenue part. The other lever you could pull is to decrease expenses, right? So maybe there are some questions. I mean, the first question you could ask your sponsor is, how are you going to improve the property operationally? Where are you looking to save money?
Yeah.
Right. And you got to listen to what they say. Right. So if somebody tells you, hey, we're planning on lowering the insurance. Okay. From what to what? It's currently at $1,000 a door. We're going to get it down to $600 a door. That's a huge number. Right. That could make a deal look so pretty. Right. So, follow-up question to that, if it's insurance related, is how many insurance quotes did you get? Right. You want to at least that they got 2 insurance quotes to back up their assumption.
Yeah.
Right. And even if they got a quote for 600, right? You don't want to hear that they're putting in 600 and they got a quote for 600. Right. If they got a quote for 600, you want to hear that they're putting in at least 10% above that.
Yeah, you always got to be conservative.
Yeah, because
you need a cushion in everything you do, really.
Right. So that's one. These are some of the operational things. Like, what are some other business plans that you see people implementing to reduce costs?
Yeah. So I think operational efficiencies, right?
Right.
I mean, there's not a lot. And so in multifamily, we have controllable expenses and non-controllable, right? So like property taxes, non-controllable.
Right.
You do want to fight them every year,
right?
But at the end of the day, it is what the city says it is, right? So as far as non-controllable, you really have your labor, which is a big one. There's a lot of opportunity there, especially with technologies today, where you could centralize things, you could leverage AI. It can be a double-edged sword as well. So you got to remember, it's like I said earlier, customer service is the lifeblood of successful multifamily. So if you say, well, they have 3 people now, but we're going to do it with 1.
Yeah.
It's like, and it's a 300 unit property, it's usually 1 person per 100 doors. So it's like, how are you going to do that? Well, AI is going to do everything. Well, then
Right.
there's a good chance they could lose the personal touch, and people are like, I don't even know who works here, right? So you got to be careful, but a lot of times you will see they're slightly overstaffed, or there's more efficient ways to do things, so you create efficiencies.
So I think you're hitting on a golden nugget that could really empower people, right?
Yeah.
So let's just give a couple of rules of thumb. Let's say it's a 200 unit Class B property, right? What kind of staff are you usually looking for a 200 unit property?
200 unit Class B, I would usually have a property manager in the office,
Right.
and a leasing person in the office.
And a leasing, okay.
Yeah, and then you have maintenance supervisor,
Right.
maintenance tech, occasionally a porter.
Right.
And then it depends how you do turns, right? Sometimes you do them in-house, sometimes you contract them
Okay.
out. So you might need additional staff for that. But that's,
Okay.
pretty common to run it well, right?
So like a 200 unit, then you got a property manager, you got a leasing person, you got a full-time maintenance guy, maintenance tech,
Yep.
right? And a porter, right?
Yeah, part-time,
Part-time,
full-time. Depends
right?
on the property.
But you definitely have at least four full-time positions on the property,
Yeah.
right? So if you're seeing a deal like that, and somebody's telling you they're going to cut down payroll, like without those 4 positions, I don't care what AI you have, it's going to be very difficult for you to maintain customer service.
Yeah.
And just because you reduce your payroll, again, like Tyler said, that could be a double-edged sword, right? You just get rid of a maintenance guy. Well, here's what happens when you get rid of a maintenance guy, okay? Now people aren't getting their requests taken care of, right? They're upset. They don't renew. Guess what happens when they don't renew? Your revenue drops.
Absolutely,
right?
yeah.
You get bad ratings. What happens when you get bad ratings? People look at your property. They're like,
pass.
I don't want to lease there. Now your occupancy drops.
Yep.
So you can't just go cutting out payroll, right? So, you want to ask questions like, how are you staffing the property? Have you staffed properties like this, right? If somebody says, somebody says, I have a 200 unit property, we're just going to have a property manager and a maintenance guy, and we're getting rid of the other positions.
Right.
It might look pretty on paper, like, oh, they're reducing all this cost, but that's going to be a nightmare in terms of what's going to happen to your renewals, your
Absolutely.
leasing. So payroll is another big one. And, T, you hit on these uncontrollable expenses, right? So one of them being insurance, the other one being taxes, right? So how can a sponsor, right, or what should a sponsor be doing in order to protect people's investment against some of these unknowns? So for example, like taxes, right? What should a sponsor be doing to make sure that they have kind of enough cushion that if taxes do go up, and like, what's your view on that?
Oh, I mean, taxes can be a deal killer. Again, everything we do, we have to build in buffers. So, we go in at 100% purchase price assessed value,
right?
Just assuming, they're going to be what we bought it for.
Yeah.
Right. And if they do more, then we'll just show them our, closing statement, and they should adjust it. And then based on where that is, we build in escalating buffer, and we usually underwrite it to be at our forecasted exit price by the time we exit.
Yep.
So basically paying our fair value in taxes, being conservative, but at the same time, you dispute those every year. You hire a very reputable, successful tax dispute company.
Yeah.
I don't really recommend doing it yourself.
Right.
These guys are pros, and they only charge you when they win, which is great. So you send them to battle for you, let them fight each and every year to try to get the value down or keep it down as low as possible.
Yeah.
So sponsors should be doing that all the time.
Yeah.
And when it comes to insurance, again, right, we don't control it. The market controls it, but bids. Every year I reach out to every insurance contact I have, and I'm like, hey, bid it again, right. And never fails. Somebody comes back with a little better price than somebody else.
Yeah, and that's a question you could ask your sponsors, like, okay, you got these insurance quotes now, whatever they are, let's say they're $1,000 a door. It's like, what are you forecasting for an increase every year? Like, you need to be forecasting. I mean, I'd be forecasting a 10% increase. Yeah. Like, I wouldn't just go based on whatever inflation is right now, because insurance, depending on the market you're in, I mean, there's hurricanes, natural disasters, insurance leave markets, so on, right? There were times where insurance jumped up by 20%. That's significant, right? But 10% would be like a good cushion, and you could ask your sponsor, like, okay, you have insurance at this. What are you forecasting year over year? If you're hearing like a 3% insurance increase per year, if you're hearing no increase, and it's a 5-year hold, I'd be like, whoa, okay. That's not conservative. With taxes also, to touch on Tyler's point a little bit, right? Like what happens sometimes, let's say you're buying a $20 million property, and when you're buying it at the time of purchase, it's only assessed at $10 million.
Yeah.
Right? So what happens is you can't assume that it's going to stay at 10 million. Right? Like really conservative and good underwriting needs to assume that as soon as you buy the property, even if it's assessed at 10 million, because the county didn't see it or didn't appraise it recently, you got to assume that it's jumping up to 20 million. Right?
Yeah, whenever they see that deed transfer, they have a flag. They're like, oh, deed transfer.
Yeah, whenever they see a deed transfer. So here's questions you could ask your sponsor around taxes, right, to see how disciplined their underwriting is. So you could ask, what is the property value? You should know that, right? Let's say $20 million. And you want to ask, what is the current tax assessed value? They're going to give you a number, right? It's 10 million, maybe it's 12, maybe it's 15. And then you want to ask is, what are you assuming the tax assessed value is going to be when you buy the property? I would say if they're assuming anything less than 85% of their purchase price, I would say that's not conservative underwriting.
I would agree with that.
You have to assume that it's going to jump up at least from 10 million to like 18 or 19. Maybe not the full 100%, because then you're not going to be competitive winning deals. But assuming that it's going to stay at 10 million at 50% of the purchase price.
It's not if, but when. When are they going to raise it? Because, I'd say like 5 years ago, you used to be able to stay at 10 million, right? You could fly under the radar and they wouldn't get you. But now they've gotten very sophisticated at the tax offices. Yeah, they use, it seems like, all the same equipment we use. The CoStars, TREP. They're literally on all these and they're seeing the CMBS loans and they know like literally what's being financed and they're working the numbers. So they get pretty close to that actual value. So if you're not forecasting at least 85, I mean that's a dangerous game. You may get lucky a year, but then they're going to catch up because, especially in Texas, we don't have a state income tax. Right. And we have, huge population growth, so they have to fund that somewhere. Right. So they're very aggressive trying to get what they can out of these deals. That's the revenue for the state. So
yeah, absolutely. I think, we touched on at least the big takeaways, right? It's like, what is the state of the market? Where is it at today? So touched on that, kind of this whole flight to quality of, people moving to these newer assets and where we see opportunity in that and how to take advantage of that. I would say these are some of the big takeaways from this year's conference. Obviously, always want to prepare you guys with questions that you can go take to your sponsors whenever you're looking at a deal. Obviously, when we're just talking, these things come to mind. We want to pass it down, but if you want to know more information about how to really dive into the deals, protect your capital, grow your wealth, it's about being educated. We believe that an educated investor is a good investor. Like, we don't want to deal, like, if you don't know how real estate syndications work, I personally don't want to bring you into our platform, right? If you just want to hear, I'm going to make 2x on my money, and it's like, okay, good enough, right? It's going to be hard, right, to have a long-term relationship. So it's about educating. So if there's any information you guys want to schedule a call with us, more than happy to set up a 20-minute call. You could email us at invest@investav.com. Tyler and I and other folks on our team all see that email box. So if you shoot us an email, we'll be more than happy to get something on the calendar.
Jump on the call.
Always looking to deliver value and help educate folks.